Stop. The IRS changed the rules on your retirement account on January 1st of this year. Not a rumor. Not a proposal. Done. And the specific people in the crosshairs are exactly the ones who spent their careers doing everything right. Maxing contributions, earning above average, trying to catch up before retirement. 3 changes, laid on top of each other, quietly. And by the time most people notice, the tax bill is already written. Imagine you and a business partner open a restaurant. Your partner provides the permits, the legal structure, the tax treatment. You provide the labor, the savings, the daily grind. You agree to split the profits eventually, when you are ready to cash out. But your partner gets to set the payout terms. And those terms can be renegotiated with notice. Technically at any point. That is your 401k. Every single dollar in your traditional 401k has a future invoice attached to it, denominated in whatever tax rates happen to exist. When you pull the money out, your 401k is a tax IOU. I am going to use that phrase through this entire video, because it is the most accurate framing I know. Stick with me for 10 minutes. The invoice has already been written. The Secure 2.0 Act was passed by Congress in late 2022. 858 pages long. Most people heard about the part where required minimum distribution ages went up. But buried deep inside that legislation was a provision originally supposed to take effect January 1st, 2024. Then delayed. Took effect January 1st, 2026. If you are 50 or older, and your FICA taxable earnings are $150,000 or more, any catch-up contributions to your 401k now have to be made to a Roth 401k with after-tax dollars. In 2026, the standard deferral limit is $24,500, with a catch-up contribution of $8,000 for those 50 and older. If you are in the 24% federal tax bracket, that $8,000 pre-tax deduction was saving you $1,920 in federal taxes per year. That deduction is now gone. You are paying taxes on that $8,000 in the current year, at your current rate. Why did Congress do this? Because the Tax IOU needed to be restructured. When you contribute pre-tax to a 401k, the government gets paid later, in 20 or 30 years, when you are drawing down in retirement. When you make Roth contributions, the government gets paid right now. This fiscal year, Congress pulled forward tax revenue from millions of high earners simultaneously, for a very specific reason that I will get to in the next section. In its February 2026 Budget and Economic Outlook, the Congressional Budget Office, CBO, projected that the Old Age and Survivors Insurance Trust Fund, OAC, will be exhausted by fiscal year 2032. That projection is a full year earlier than the 2025 Social Security Trustees Report, which had set the depletion date at 2033. The average Social Security retirement benefit as of April 2026, $2,081 per month. A 23% reduction would cut that by roughly $479 per month. Nearly $5,748 per year. Over a 20-year retirement. $114,960. That Raymond did not plan for. And Raymond does not know his retirement math is already broken. 3 forces push the depletion date forward. The Social Security Fairness Act added more than $17 billion in retroactive payments, accelerating outflows. The One Big Beautiful Bill Act Reduced payroll tax revenue flowing into the system. And the demographic math keeps grinding forward. Roughly 10,000 baby boomers turn 65 every day, expanding the beneficiary rolls faster than the worker base can support. Congress's response has not been a structural fix. It has been incremental restructuring of retirement accounts, including the Roth catch-up mandate that pulls forward tax revenue, without anyone calling it a Social Security solution. The government is solving its fiscal problem using your retirement account, not by confiscating it, by changing when it collects. The third mechanism, the one that has been running silently inside your account since the day you opened it. Worker invests $100,000 with 0.5% in fees. After 30 years at 7% return, the account grows to about $574,000. Worker B invests the same amount, but pays 1.5% in fees. After 30 years, the account grows to only about $432,000. The difference, $142,000, lost entirely to fees. That is not a worst-case scenario. That is a typical gap between a high-cost actively managed fund and a low-cost index fund inside the same employer plan. Over a lifetime, fees can cost a median income to earn a family nearly $155,000 and consume nearly one-third of their investment returns. Here is the structural beauty of a fee expressed as a percentage of assets. It does not appear on your statement as a line item called fee withdrawn. It reduces the reported growth rate. You see the net return, the gross return, what the market actually did before the fund company took their piece, is never displayed. You feel neutral about an account growing at 6.3%, without knowing that the underlying index returns 7.5. The difference is invisible, compounding quietly against you, year after year. Meet David. David is 52 years old. He earns $180,000 in FICA wages. He has been maxing his 401k every year since age 48. His current balance, $380,000. Almost entirely in his traditional pre-tax account. He has not read his plan documents in 3 years. David does not know that his plan administrator quietly added a Roth feature in January 2026 to comply with Secure 2.0. David also does not know that his payroll system automatically started routing his $8,000 catch-up contribution into the Roth side. His taxable income is $8,000 higher than he expected this year. At his rate, that is approximately $1,920 in additional federal taxes he was not budgeting for. Here is David's deeper problem. David's $380,000 is almost entirely in the traditional pre-tax bucket. Every dollar he pulls out in retirement is taxed as ordinary income, not capital gains rates. Ordinary income. If David retires at 65 and pulls $60,000 per year from his 401k, and his Social Security is $2,081 per month, that is roughly combined income of around $85,000 annually. Puts him in the 22% bracket. Fine. Mostly. Here is what he has not modeled. The 23% Social Security cut. David's 2081 check becomes 1602. He now needs to pull more from his 401k to maintain his lifestyle. Say an extra $5,000 per year. That additional income pushes him further into the 22% bracket. May also push him above the IRMA Medicare surcharge threshold, adding potentially $70 to $300 per month to his Medicare costs. The account balance and the spendable income are two completely different numbers, separated by a tax structure he has never fully modeled. Step 1. If you are 50 or older, and your FICA wages were above $150,000 last year, verify this week how your catch-up contributions are being classified. Call the plan administrator. The rule is permanent and based on your prior year W-2 from the employer sponsoring the plan. Your payroll system may have silently moved those contributions to Roth in January. That changes your current year taxable income. You need to know before April. Step 2. Request your plan SV disclosure, the 404A-R5 notice. This is a legal document. Your employer is required to provide it. Find the total expense ratio for the funds you actually hold in your account right now. If you are in actively managed funds at 1% or higher, and your plan offers index funds at 0.1% to 0.2%, the difference compounds against your balance at a rate that produces six-figure losses over a 20-year horizon. Step 3. Run your retirement income projection twice. First, with your current Social Security estimate at full benefit. Then, with that number reduced by 23%, using the BOS's own published depletion scenario for 2032. If the second version of your projection creates a shortfall, meaning your plan depends on Social Security working at full capacity, that plan has fragile assumptions. The buffer you build now, through Roth contributions, additional taxable accounts, or a different withdrawal sequence, is not pessimism. It is accuracy. Lazy investing built more fortune than crypto memes. The 401k is still a good deal, given the employer match, the compounding runway, and the tax deferral. The problem has never been the account. The problem is the gap between the number on your statement and the number you will actually be able to spend. Quietly engineered through fees, tax liabilities, and policy decisions made in rooms you were never invited into. The people who understand the actual terms of the deal are the ones who end up with spendable money, not just statement money. Here is what you will do right now. 1. Hit subscribe, because the algorithm will not show you the next video if you do not. 2. Find your 401k statement. Look at the total expense ratio. If you do not know where that is, call our tomorrow. 3. Send this video to one person who says, "I have a good advisor." Tell them, a good advisor will explain fees in dollars. Because David did not know. His payroll system did not tell him. Now you know. The Tax IOU. Time to pay it down. See you in the next video.